What happens when traditional currencies lose their value due to inflation? How does this impact the world of cryptocurrencies? Well, the rise of cryptocurrencies has provided an alternative that operates independently of government-controlled monetary policies. In this video, we will look at how inflation and crypto intersect, creating a dynamic landscape where investors and users seek protection and stability. Join us on a journey to explore the fascinating relationship between inflation and the ever-evolving realm of cryptocurrencies. But first, what is inflation? In simple terms, inflation is the rise in prices over time. This rise in price leads to a decline in your purchasing power or how much you can buy with your money. When measuring inflation, central banks use indexes, such as the Consumer Price Index and the Producer Price Index. Monetary inflation is a sustained increase in the money supply of a country, while consumer price increases are often confused with monetary inflation. Central banks have little direct control over the former, but can influence the latter. Crypto inflation. It's difficult, if not impossible, to confidently say how inflation will affect cryptocurrency. This is because cryptocurrency as an asset has only existed for a little over 10 years. During most of that time, major economies experienced little significant inflation. As a result, the inflationary pressure of 2021 to 2022 is the first time that investors have traded cryptocurrency during an era of significant consumer price hikes. Crypto is not a currency. Cryptocurrency, unlike traditional currencies, does not respond to inflationary pressures typically experienced by fiat currencies. Advocates of cryptocurrency argue that it serves as a counter-inflationary asset, as its value tends to increase when the value of local currencies declines. In times of weakening currencies, individuals may opt to store their wealth in cryptocurrencies like Bitcoin, aiming to preserve their purchasing power. This increased demand can further drive up the value of cryptocurrencies. However, this perspective is flawed on multiple levels. It contradicts observable trends. Inflation rates have reached their highest levels in 4 decades during 2021 and 2022, while the cryptocurrency market has simultaneously experienced significant value declines, with a roughly 2/3 reduction. Relatedly, this is also incorrect because crypto is not and never has been a functioning currency. Neither the IRS nor the SEC recognizes cryptocurrency assets as cash holdings. Instead, the SEC has determined that crypto assets fall into 2 investment classes. Crypto as a commodity. Bitcoin, along with other assets with predetermined quantities and characteristics, is categorized as a commodity, similar to gold and silver. Despite being a digital asset rather than a physical one, it operates on similar fundamental principles. The quantity of Bitcoin in existence is determined by the asset's algorithm. Just as the amount of gold that can exist is determined by what is naturally found in the ground, Bitcoin lacks an underlying enterprise that would alter its inherent nature. Similar to gold, silver, iron, and lumber, Bitcoin exists as it is, and investors can freely buy, own, and sell it according to market conditions. Crypto as a security. Utility tokens or stablecoins, which can be generated by the underlying project as needed, are categorized as securities similar to stocks or bonds. Although they are non-traditional assets, tokens operate based on the fundamental principles of securitized assets. An enterprise creates a set of tokens and offers them for sale on the open market. The project has the ability to generate new tokens or remove existing ones at its discretion, and the characteristics of the token are determined by the nature of the underlying project. The value of a utility token is influenced by the business decisions made by the issuing project, much like the value of a stock. Regardless of whether a cryptocurrency is classified as a commodity or a security, it should be noted that it is not a currency. As a result, its behavior will not resemble that of a typical currency. Instead, during a period of inflation, investors should anticipate that a cryptocurrency will adhere to the characteristics of a high-risk investment asset class. Inflation leads to higher interest rates. In response to inflation, the Federal Reserve typically increases its benchmark interest rate, which reduces the demand for speculative investment assets. This shift makes secure, debt-based securities more attractive and raises the cost of liquidity, ultimately slowing down investor activity. These trends are expected to have a negative impact on cryptocurrencies. In an environment of low-cost borrowing and ample liquidity, it is easier for investors to engage in speculative and high-risk assets like cryptocurrency. The theory behind the significant rise in cryptocurrency value suggests that investors had substantial funds with limited alternative investment options. However, as the Federal Reserve raises interest rates, both of these factors are likely to change. Consequently, the prices of cryptocurrencies, along with other capital gains-oriented assets, may decline. It's worth noting that commodities typically behave differently in relation to inflation. Raw goods, such as commodities, are often seen as leading indicators of inflation, with their prices increasing alongside inflationary pressures. However, precious metals, which share similarities with Bitcoin, and other commodity-based cryptocurrencies do not consistently exhibit a significant price relationship with inflation. For instance, between 2000 and 2011, while inflation remained stable, the price of gold surged by nearly 600%. Conversely, from 2011 to 2015, when inflation hovered around the Federal Reserve's 2% benchmark, gold lost almost half of its value. Instead, precious metals commodities tend to perform well during economic downturns. On the other hand, high speculation assets like cryptocurrency are more prone to suffering rather than thriving during a recession. Inflation makes investors cling to stability. Gold is commonly regarded as a stable asset, attracting investors who seek stability and reinforcing its perception as a reliable investment. However, this is not the case for cryptocurrency, as it neither possesses the inherent nature nor the perception of stability. Commodity-based cryptocurrencies have not established a practical economic use as a currency. Similarly, projects based on securitized tokens have yet to launch successful consumer end products. Instead, these assets function more like lottery tickets, offering the potential for significant, even enormous returns with relatively small investments. They tend to thrive in an environment where investors have surplus funds and feel comfortable taking risks. Inflation causes uncertainty, which leads to security investing. When investors start feeling uncertain about the stability of their investments, they tend to invest towards more secure options. This behavior is particularly noticeable among individual investors who play a significant role in the cryptocurrency market. They may choose to withdraw their funds from investments altogether, which can adversely affect the value of cryptocurrencies during times of inflation and worsen losses during a recession. However, it's important to acknowledge that bond yields and cryptocurrency returns have always exhibited unbalanced profiles. Investors who are willing to accept the potential for total loss or explosive growth offered by cryptocurrencies might not be swayed by the relatively modest yet stable gains of bonds. Furthermore, despite higher yields resulting from Federal Reserve rate increases, many bonds tend to underperform in the face of significant inflation. In the current scenario, where inflation rates are uncertain, investors who opt for bonds with yields of 4, 5, or 6% may still experience a decline in portfolio value compared to an inflation rate of 8 or 9%. These factors could provide some level of support to cryptocurrency prices as investors search for assets that have the potential to outperform high inflation, even if it entails some level of risk. As an asset class, cryptocurrency lacks a trading history specifically during periods of inflation, making it challenging to accurately forecast the impact of inflation on its prices. Nevertheless, investors can draw insights from the behavior of comparable asset classes to form certain predictions. Despite this, it is crucial to acknowledge that investing in cryptocurrency carries inherent risks under any market conditions. Seeking guidance from a financial advisor with expertise in crypto can be invaluable when making investment decisions. Alright guys, that wraps up our video for today. If you enjoyed watching this and you find it useful, please give us a thumbs up and hit the subscribe button for more.